also joined by Mr. Sunil Reddy, who is the Managing Director at Dodla Dairy, who joins us now. Welcome to the show, Mr. Reddy. Lots happening in the dairy sector overall. So, I'll go with my first question from a broader-based perspective. What are the kind of trends that you're observing in the dairy industry? Overall, Q1 was did witness a good growth, and how are you seeing overall FY25 shaping up?
First of all, good morning and thank you so much for getting me onto your show. The broad trends are milk prices have been pretty stable in the procurement side, weather patterns being more stable. And I think that is the reason why we think even margin profile, like how we have seen the first quarter improvement, will continue in the same manner till the end of the year. We are also having a slight uptake in terms of value-added product sale because we had more milk in the system. So our ghee sales have also increased with ice cream and ghee and such sales increasing. That also helps our profitability to improve. So I think this year will be a good year for the dairy industry.
All right. So in terms of volume growth, what do you believe maybe beyond even FY25, what's the volume growth going to be like? And is it going to come from more from newer markets, or are you going to expand more in existing markets itself?
So traditionally, we have been able to manage a growth of around 10% by volume and 15% by revenue, 5% being either a product mix change or inflation that comes into play. And being in the dairy industry does go through a certain bit of cyclical trends in terms of when there is oversupply, we might see a little bit of lower offtake in the liquid volume, which will be compensated by ghee and powder that we sell. But I think in the years to go forward also, we will look at the same kind of numbers where we will look at, although the base is increasing, we will keep targeting the same growth of 10% by volume and 15% by value.
All right. Mr. Reddy, I want to understand that value-added products growth was roughly at 21% in quarter gone by. Firstly, I want to understand that what is the product mix right now in terms of value-added products versus your normal products. And, I'm seeing a trend overall in the dairy industry is that value-added products are picking up and companies are actually focusing on value-added products. So what is your strategy with respect to that? Where will the mix be at from a longer-term perspective?
So I think right now the biggest value-add product that we sell is curd, which will be followed by ghee, then followed by ice cream and flavored milk and other such categories which we have. I think it is also the question of consumer preferences changing and the industry keeping up to the consumer preferences. Earlier, people used to buy milk and make curd at home. Now people are buying curd from the market. And I think other trends will come in. Maybe it will be fermented drinks that come in like lassi, buttermilk and such products, or flavored milk itself as a category increasing with multiple things coming into play. I think we will be this year, we think we will clock around 32% coming in from value-added products, which will see a significant offtake coming from ghee. Earlier years, we used to be very cautious about trying to push ghee as a branded value-added product because of the raw material fluctuation in terms of not having products some certain years in terms of surplus of fat. I think we are rectifying that, and therefore that will also start to play a major role for us in terms of our value-added profile enhancing.
Right. So then your margins currently are at roughly 11.5%. So will you see an improvement in your margins if your contribution from value-added products will increase to 32% mark?
I think to look at a longer term view, we will keep it at these levels, which will be there plus or minus 1 or 2%. Yes, in the short term, these margins will continue. Like I said, it's a good year for the dairy industry. But in a cyclical manner of 2 to 3 years, I think we can look at it and to keep it either in the high single digits or low double digits as a margin that we go forward to.
Right. And is that, how is raw material pressure coming through, sir?
Raw material has been sort of stable this year. That has been the biggest boon in terms of neither did it go up too much nor did it drop too significantly. We'll have to wait and watch because I think the weather patterns changing also impacts the production yield of animals because more monsoon, too much of monsoon is bad, too little monsoon is also bad. So, but right now, this year, it's holding good. I think higher prices that were offered, which are being able to be passed on to the customers, are also keeping a larger section of the farming community happy. And therefore, it looks like this good trend will continue for a while.
All right. Mr. Reddy, your revenue contribution from Africa has been increasing, and currently it is at roughly 9%. And you've also said that revenue from Africa will double to 360 crore in FY25. So, I want to understand that how is the Africa business shaping up? If it is at 9% right now, from a longer term perspective, where will it go? And then overall blended margins, where will they stand at?
Africa is actually a high margin, lower volume kind of a business, ma'am. As we look at our growth, as we see as Dodla growing, if you're continuing to maintain the same growth pattern, Africa will remain maybe from the 9% can move to 10 or 11% as an increase in overall the share of the top line. And it will also continue with the similar bottom line kind of a share. We will not be pushing Africa aggressively. We have to be careful of how much we go into Africa because we have to be very careful about country risk, currency risk, and other such factors, not only the availability, not only the local businesses. Keeping that into consideration, we will keep Africa into the same level. So we are very confident that even at a 360 crore Africa, Indian business will grow to such an extent because we also have a cattle feed that put together it will still remain 10 to 11% of revenue.
Got it. And in terms of margins, sir, you suggested Africa is better. How much better? Just if you can give us an indication.
India is working currently at 10-11%. Africa will be at 18-19%.
Oh,
and
okay.
Africa is almost a stable 18-19% kind of a margin that we operate there.
Okay, got your point. And so again, I'll stick with the margins question. You're doing better on the Africa front. You're going more into value-added product. What's keeping a cap on margins therefore? Just if we can
as a
understand
dairy
that.
industry, sir, we have to be careful that just because for margin, we should not sacrifice either the farmer nor the customer.
Sure.
We have to be very cautious about what we do. If you overprice the product, we might start losing the consumer base because people will find dairy to be too expensive and might try to bring down on the dairy consumption. So we are very cautious in terms of, if you look at it, we are doing well in the areas where the GDPs are higher, where we're able to do a mass premiumization and sell the product. There's even a significant part of the country where the GDP is not that high, where milk prices do make a difference or product price make a difference. In the same manner, we cannot also kill the farmer if we are able to, if there's too much of supply in the system. If we kill the farmer too much for the short term, we will lose him in the long run. So I think in that manner, we have to keep it equal. We rather go by return on capital and the cash flows that we generate. And on that grounds is what we look at keeping our pricing going.
Right. And with respect to your cattle feed business, you know, your capacity is at roughly 13,000 tons per month, but utilization is at, 5,000 tons roughly. And you've also said that you're expecting turnover to double from this segment as well. So, how are you expecting that to happen, first thing? And overall, how much of a contribution does cattle feed give to your business?
Cattle feed right now is very small. It's around 7 to 8% of the business which is there. We actually had only a 2,000 ton per month capacity earlier, which we had acquired. We recently, as recent as March, added 10,000 tons more. So that's made it around the 12,000 tons as full capacity. So we're looking at it now at 12,000. When we're reaching our 4,000, 5,000 itself in the first year of operation, we're pretty much confident that we will be able to utilize the whole capacity. This is predominantly used to give it to our own farmer base. We have not even touched 20 or 30% of our farmer base where we are giving our own cattle feed. So that is the reason why we are very confident of saying if we enhance it even to 60% of our farmer base, we will be able to achieve full capacity.
How quickly do you get there?
We are hoping within a year or two.
Okay. And thereafter more capex, is that what will be lined up for this segment?
Yes, because I think the same volume, when we look at 10% of volume, if I have to keep increasing, if we are at a current base of 1.6 million liters per day, and if you have to keep adding that,
right,
that will entitle so many of the same farmers, that number of farmers will increase, or even if the depth of cattle feed increases, that is how it will go.
And therefore, just the fact that this is faster growing than your 15% top line, and therefore will command a better mix going forward?
It's not in a better mix because I guess, we take the three lines. If I take it as India Dairy, Cattle Feed India and Africa, one or the other might not be, all three might not be firing at the same speed. So we try to be more on the conservative side and say the blended average of these will continue to be in the same state of growth.
All right. Mr. Reddy, I also want to understand, in terms of your distribution strategy, because you're concentrating on B2C to, make sure that your products remain premium. But I also want to understand that what are your strategies with respect to, expanding geographically?
So geographically, we do look at acquisitions or our own greenfields that we go forward for expansion. We normally try to make it contiguous from where we are operating. We have already announced that we're actively looking at Maharashtra to start a plant there, which will be used mostly initial days as balancing of our input-output that we require, and later enter not necessarily the Mumbai areas, but more of the southern parts of Maharashtra kind of a market for us to enter. And if we get opportunities, we will also look at entering into other states. That is going to be from a point of view of the expansion of the width. coming from the depth, we are doing more things in terms of trying to be available in more of the modern trade, keeping our ice cream penetration larger, trying to have our own retail outlets, which are trying to blend all products under one roof, and a lot more of such activities to increase our depth of penetration in areas where we're already existing.
And Mr. Reddy, just with regard to competition, we've spoken to a couple of dairy players now. Everyone's going into value-added products. Anything that you are facing in terms of both competition, anything you're doing differently in comparison to what your competition is doing?
So I think majority, broadly speaking, will all be in the same boat in terms of a little bit, because it's a consumer that matters more. But I think as we are growing as companies from where we were to what the companies have come from, the size of the players are all becoming larger. I think it's going to be more issues coming from managing larger size of operation, management, people, systems that will come into the play. And with that, I think a lot more of consolidation is going to happen as we go forward. Competition will be there. It's going to be there in every field. That is, we've been facing it from the past at least 10, 15 years that all of us have been in the same field. We're all growing in the same areas. I think growth is also coming with consolidation happening in the markets.
All right, Mr. Reddy, one last question. You said that you might look for some acquisition when it comes to geographical expansion. Any fundraising on cards?
No, not required, ma'am. We're debt free. We're net debt free. We have enough of cash in the books with us, so we keep that cash normally for such opportunities that come. But we have to be careful that we don't overpay for these opportunities, and that's where we're cautious about.
And is there a ticket size that you're looking for?
Ticket sizes are normally in the range of 100 to 200 crores is what we do. We maintain a cash balance of net cash with us of around 300 to 350 crores. So that is well within our range of what cash we have to what we acquire.